Hello friends, welcome back to my channel. $50 billion. That's not a guess. That's not clickbait. That's not some random number I pulled out of thin air. That's the estimated value of what one single bank, JP Chase, has quietly accumulated in the silver market. And the way they did it will make your blood boil. Because while they were telling you that silver is just a boring, outdated metal, while they were suppressing prices with paper contracts, while they were paying billion-dollar fines for manipulation and calling it cost of business, they were doing something else entirely. They were buying millions of ounces year after year, quietly, secretly, building the largest private silver stockpile in modern history. And when you understand why they did this and what comes next, you'll realize you're not just watching a video about silver, you're watching the blueprint of the biggest wealth transfer in decades. And most people, they're on the wrong side of it. But first, let me ask you a question. If silver is such a bad investment, like mainstream media keeps telling us, then why is the most powerful bank in America hoarding it like their survival depends on it? That question kept me up at night, and when I finally found the answer, everything changed. Let's start from the beginning. The year is 2008. The financial world is collapsing. Bear Stearns, one of the biggest investment banks, is about to go under, and they have a problem, a massive problem. Bear Stearns was short silver, hugely short. We're talking tens of millions of ounces of paper silver they had sold but didn't actually own. If silver prices spiked, Bear Stearns would be finished. Not just bankrupt, completely wiped out. Enter JP Morgan. In March 2008, JP Morgan acquired Bear Stearns for $2 per share. Pennies on the dollar. A steal. But here's what nobody talks about. JP Morgan didn't just buy Bear Stearns. They inherited that massive silver short position. And that's when the game changed forever. See, most banks would look at that short position as a liability, a risk to manage, something to close out. But JP Morgan, they saw an opportunity. An opportunity so big, so audacious, that it would take them 15 years to execute. And we're only now seeing the final pieces fall into place. Here's what they did. And pay close attention, because this is where the genius of the trap becomes clear. Instead of closing the short position, JP Morgan expanded it. They became the dominant short seller on COMEX, the world's largest precious metals exchange. Every time silver tried to rally, JP Morgan would dump paper contracts, millions of ounces worth, sometimes in minutes. The price would crash, retail investors would panic sell, stop losses would trigger, and then JP Morgan would quietly cover their shorts at lower prices and buy physical silver on the side. Read that again. They suppressed the paper price while accumulating the real metal. It's like a real estate developer spreading rumors that a neighborhood is dangerous so they can buy all the houses cheap before announcing a massive development project. Except this isn't houses, this is silver, and the scale is almost incomprehensible. Now, I know what some of you are thinking. This sounds like conspiracy theory territory. Where's the proof? Fair question. Let me show you. Proof point number 1, the billion-dollar confession. In September 2020, JP Morgan agreed to pay $920 million to settle charges brought by the Department of Justice, the CFTC, and the SEC. The charges? Manipulating the precious metals market, not alleged, admitted. The DOJ called it one of the largest cases of market manipulation ever prosecuted. JP Morgan traders were caught placing thousands of fake orders, a technique called spoofing, to manipulate gold and silver prices. They would place massive sell orders to push prices down, then cancel them before execution. Meanwhile, they'd execute their real trades at artificially low prices. One trader alone made over 50,000 fraudulent trades. This wasn't a rogue employee. This was systematic, company-wide, spanning nearly a decade. And the fine, $920 million, JP Morgan made an estimated $2 to $3 billion from these manipulative trades. The fine was a 30% tax on their illegal profits. That's it. In any other industry, executives would go to prison. The company would face existential consequences. In banking, they paid the fine, didn't admit wrongdoing, and went right back to business. Actually, let me correct that. They didn't just go back to business. They accelerated their physical accumulation, because now they knew the playbook worked. The fine was just proof of concept. Proof point number 2, the vault receipts. This is where it gets really interesting. JP Morgan operates one of the largest COMEX-approved silver vaults in the world. They're literally the custodian for a massive chunk of the exchange's silver. And starting around 2011, something strange started happening. Silver began flowing into JP Morgan's vault, millions of ounces, month after month, year after year. But here's the twist. Most of the silver was categorized as eligible, meaning it was privately owned, not available for delivery against futures contracts. In other words, JP Morgan wasn't just storing silver for COMEX. They were storing silver for themselves. By 2019, estimates suggest JP Morgan had accumulated between 600 million and 900 million ounces of physical silver. Let me put that in perspective. Global silver mine production is about 850 million ounces per year. JP Morgan accumulated an entire year's worth of global mine production. Maybe more. That's not a position, that's a monopoly. Proof point number 3, the timing of accumulation. Here's what makes this even more suspicious. When did JP Morgan accumulate most aggressively? When silver prices were low. When was silver price low? When JP Morgan was suppressing it with paper shorts. Coincidence? Let's look at the data. 2011, silver spikes to $50. JP Morgan increases short positions. Price crashes. JP Morgan buys physical. 2013, silver drops to $18. JP Morgan's vault holdings surge. 2015, silver hits $14. More physical flows into JP Morgan's vault. 2020, COVID crash takes silver to $12 briefly. JP Morgan's physical accumulation accelerates. You see the pattern? They crash the paper price. Retail investors panic, sell their physical. That physical eventually flows into JP Morgan's vault. Rinse and repeat. They've been running this playbook for over a decade. And now? Now they're sitting on the largest private silver hoard in history. Why would the most sophisticated bank in America spend 15 years accumulating a useless relic? Why would they pay billion-dollar fines just to keep the scheme going? Why would they risk criminal prosecution? The answer is simple. They know what's coming, and they're positioning to be on the right side of it. Let me explain what I mean. Silver isn't just a precious metal anymore. It's become one of the most critical industrial materials on the planet. Every solar panel needs silver, and the world is installing solar panels at an exponential rate. Every electric vehicle needs silver, more than a traditional car. Every 5G tower, every smartphone, every medical device, every water purification system, silver. Global silver demand hit all-time highs in 2023 and 2024. But here's the problem. Silver mine production has been flat for a decade. Actually, it's declining. Ore grades are falling, new discoveries are rare. Opening a new mine takes 15 plus years. We're consuming more silver than we're mining. The deficit has been growing for 4 consecutive years. And above-ground stockpiles, they're being drained. This is basic supply and demand. When demand exceeds supply, prices rise, unless someone is artificially suppressing the price, which JP Morgan has been doing systematically for over a decade. But here's the thing about price suppression. It works until it doesn't. You can manipulate paper markets. You can create infinite paper contracts, but you cannot print physical silver. At some point, industrial users need real silver. Solar manufacturers need real silver. Electronics companies need real silver. And when they show up to buy and the vaults are empty and JP Morgan is the only one with supply, what do you think happens to the price they can charge? This is the $50 billion trap. JP Morgan suppressed prices for over a decade. They accumulated physical silver at artificially low prices. They built a monopoly position. And now they're waiting for the supply crisis to become undeniable, waiting for industrial users to panic, waiting for the price to explode. And when it does, their $50 billion position could become $100 billion, $200 billion, maybe more. Meanwhile, the retail investors who sold their silver in frustration during the years of manipulation, they'll be watching from the sidelines, wondering what happened. That's the trap. And millions of people are caught in it without even knowing. But wait, it gets worse. Let me show you how the trap works for everyday investors. Most people who invest in silver don't buy physical bars and coins. That's inconvenient, hard to store, expensive premiums. Instead, they buy ETFs, paper silver, futures contracts. The most popular silver ETF is SLV, the iShares Silver Trust. Guess who the custodian is? JP Morgan. Read that again. JP Morgan, the bank caught manipulating silver prices, is the custodian for the world's largest silver ETF. They literally control the metal that's supposed to back your investment. But here's where it gets really interesting. Read the SLV prospectus carefully. Most investors don't. It says, and I'm paraphrasing, that the trust may not always have enough silver to back all shares, that the custodian can use sub-custodians whose silver holdings aren't independently verified, that in certain circumstances, shares may be settled in cash rather than metal. In other words, if there's a run on SLV, if everyone wants their silver at once, you might not get silver. You'll get cash at whatever price JP Morgan decides is fair. And JP Morgan, who controls the paper price through their short positions, gets to decide that price. See how the trap works? They control the paper market. They control the ETF. They control the vaults. They control the price. And they've accumulated more physical silver than anyone else. No matter what happens, they win. Unless people stop playing their game, unless people demand physical delivery, unless people take their silver out of the system JP Morgan controls. That's what's starting to happen. and it's why the end of this game might be closer than anyone thinks. Let me show you the signs that the trap is about to spring. Sign number 1, vault inventories are collapsing. COMEX registered silver, the silver actually available for delivery, has dropped from 150 million ounces in 2021 to around 30 million ounces today. That's an 80% decline in just a few years. More and more investors are standing for delivery. They're saying, enough paper, give me the real thing, and COMEX is struggling to meet demand. Sign number 2, premiums are exploding. The premium is the difference between the spot price and what you actually pay for physical silver. In a normal market, premiums are 5 or 10%. During stress periods, premiums have spiked to 30%, 50%, even 100% above spot. This tells you something important. The paper price is a lie. The real price, what people actually pay for real silver, is much higher, and that gap is widening. Sign number 3, Eastern accumulation is accelerating. And while Western investors are trapped in paper games, the East is accumulating physical. China has been quietly building its silver reserves. India imported record amounts of silver in 2023 and 2024. Russia, the Middle East, and other nations are stockpiling. They're not buying SLV. They're not trading futures. They're taking physical delivery. They understand what Western investors are only starting to realize. When the music stops, only physical metal matters. Sign number 4. Basel III rules changed the game. In 2021, new banking regulations called Basel III went into effect. These rules changed how banks account for gold, making physical gold a Tier 1 asset, equivalent to cash. Many analysts believe similar rules for silver are coming. If that happens, if physical silver becomes a Tier 1 asset, banks will need to hold more physical and reduce paper exposure. What happens to the paper-silver market then? What happens to all those short positions? What happens to the price? Sign number 5. Industrial panic buying has started. Solar manufacturers are worried about silver supply. Some are signing long-term contracts at above-market prices just to secure supply. Electronics companies are starting to stockpile. Tesla and other EV manufacturers are talking about silver supply constraints. This is exactly what happened with palladium in the early 2000s. Industrial users got nervous, started hoarding, and the price went up 10x. Silver is setting up for the same dynamic, and JP Morgan, they're sitting on enough silver to meet that demand, at whatever price they choose. So what does all this mean for you? What should you actually do with this information? Well, let me give you a framework, not financial advice, just a way to think about this. First, understand what you actually own. If you own SLV or other silver ETFs, you own paper. You own a claim, you don't own silver. That claim is managed by the same banks who have been caught manipulating the market. If you're okay with that counterparty risk, fine, but go in with eyes open. Second, consider physical ownership, coins, bars, metal you can hold in your hand. Metal, no exchange, can redefine or freeze. Yes, there are premiums. Yes, there are storage considerations. But when the paper market breaks, and history suggests it eventually will, physical holders won't be asking permission to access their wealth. Third, understand the ratio play. The gold to silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio averaged around 15:1. Today, it's around 80.1 or higher. Some analysts believe this ratio will revert. If it returns to even 40.1, silver would need to roughly double relative to gold. Fourth, watch the warning signals. Monitor COMEX registered inventories. They publish daily reports. Watch for delivery failures or unusual settlement procedures. Pay attention to premiums. They tell you what the real market is doing. And most importantly, be skeptical of anyone telling you silver is boring or worthless. Ask yourself, why would JP Morgan accumulate 15 years worth of something boring and worthless? Fifth, think long term. I can't tell you when this trap springs. Neither can anyone else. It could be months, it could be years, but the fundamentals are clear. Supply deficits are real. Industrial demand is growing. Paper claims exceed physical reality by a massive margin. Something has to give. The only question is whether you're positioned before it happens or after. Now, I want to address something important. Some people will watch this video and think I'm being sensationalist, conspiracy-minded, over the top, fair criticism. Let me respond. Everything I've told you is based on public court documents from the DOJ settlement, COMEX Vault reports that anyone can access, SEC filings and ETF prospectuses, industry supply and demand data from the Silver Institute, historical price data and trading patterns. I'm not making this up. I'm not speculating. I'm connecting dots that are publicly available. The question isn't whether this is happening. The evidence is overwhelming. The question is what you do about it. And I think there's a deeper question too. What does it mean when the most powerful financial institutions can manipulate prices, pay a fine, and continue operating? What does it mean when the custodians of our financial system have a direct conflict of interest with the people they're supposed to serve? What does it mean when paper promises exceed physical reality by orders of magnitude? These aren't just questions about silver. They're questions about the system itself. And maybe, just maybe, that's why understanding silver matters. Because silver exposes how the game really works. It shows you who the players are, what their incentives are, how they think. And once you see it, you can't unsee it. So here's my challenge to you. Don't take my word for any of this. Do your own research. Read the DOJ settlement documents. Look at the COMEX data. Read the SLV prospectus. Form your own conclusions. But whatever you do, don't ignore this. Don't assume the price on your screen reflects reality. Don't assume the institutions managing your money have your best interests at heart. Think for yourself. Question the narrative, follow the evidence, and position yourself accordingly. Because when the $50 billion trap finally springs, when paper promises meet physical reality, you don't want to be on the wrong side. JP Morgan isn't. The question is, are you? Until then, stay informed, stay skeptical, and always follow the money. I'll see you in the next one. One final thought before I let you go. Throughout history, there have been moments when artificial systems break, when reality catches up to manipulation, when fundamentals reassert themselves. It happened with Enron, with subprime mortgages, with the London Gold Pool in 1968, with the Hunt Brothers Silver Corner in 1980. Every time the experts said the system was stable, every time the prices were correct, every time the manipulation would continue forever until it didn't. We're in one of those moments now, maybe not at the breaking point yet, but the pressure is building. The vaults are draining, the deficits are growing, the industrial demand is surging, and JP Morgan, the most sophisticated bank in the world, has spent 15 years preparing for what comes next. They're not hoping silver goes up. They're certain it does, and they've built a $50 billion position based on that certainty. The trap is set. The only question remaining is, which side of it are you on? If this video opened your eyes, if it made you think differently about silver, about markets, about how the system really works, do me a favor. Hit subscribe, turn on notifications, because this is just one piece of a much bigger puzzle. Next video, I'm going to show you something even more explosive. The specific signals that will tell us when JP Morgan is about to flip from suppressing silver to letting it run. There are patterns in the data, warning signs, and when you know what to look for, you'll see them before the crowd. You don't want to miss that.